Welcome guys to part 2 of Trading 101. So on the first part, you heard me just blabbering on about the basics of whatever it is we're going to trade, like options and future, as well as looking at the basics of the option chain too. And this part is going to be the most important part because we're going to be diving in to my entire strategy, how I trade, and all like that, okay? And the third part is going to be a little bit different, a little bit quicker, but we'll get into that later in the third part, or later in this video. I'm going to be telling you guys kind of the gist of the third part of the last part of the course. But in this part, we're going to be doing everything about looking through the market structure, looking through my strategy, what my strategy really means, what my concept means, what my setups are, how to identify my setups and how to get into that play, how to have proper risk management, how to, assess your win rate of your strategy and figure out what your risk reward ratio should be. All of that is going to be inside this course, inside this part in this video, okay? So let us get into it right now. This is going to be the most difficult part of it, so just make sure you're listening. Feel free to pause the video, jot down notes or go back in the video, figure out what it is you're not really getting, because this video is going to go through a lot, okay? But first thing we're looking at now, the first thing you got to know when it comes to actually trading is, market structure. You're going to understand how the market moves. There's only 3 ways the market can move, okay? And the market can move in an uptrend, a sideways trend, or in a downtrend. And what that means is, as you can see already here in the diagram here, but we have a uptrend that's going in higher highs and higher lows. So it's just creating higher highs and higher lows. As you see, it went up, had this high right here, went down, had this low. As it went up, it created a higher low, a higher high, surpassed this high, and it created a higher low because it dipped down here, but it didn't cross this low here, so it created a higher low. This is what we call an uptrend, okay? And then we have sideways trend. So with the sideways trend, it's moving, as you can see here, there's creating no higher highs and no higher lows, no lower lows and no lower highs, okay? So it's just going in the same pinpoints, all right? So it started here, it dipped down here, it created a high, created a low, went to the same high, went to the same low, went to the same high. That's what a sideways trend is, okay? And then we have a downtrend. So with a downtrend, it's just the opposite of an uptrend. We're creating lower highs and lower lows. So it goes down, has a high here, has a low here, created a lower high because it didn't surpass this high, and it surpassed this low, so it created a lower low. That's what a downtrend means, okay? And what this basically means in terms of, trading, why you need to know this, is because you need to know exactly, what type of trade to get into. If you want to go long or short, this trend always helps you find the best, the best way to go, either long or short. With a trend, you always want to go with a trend. So that's basically what I mean. How to play off trend is because you always want to go off the trend. So we want to see consolidation, like I said here, sideways trend. We're going to be looking at playing both sides of the range. So this is probably the best of both, because it's going in a sideways trend. We can play either short or long. So it comes down here, we can play long. We can play short as well. If it comes up here, we can play short, or we can play long. It doesn't matter because it's a sideways trend. They're both valid. They're both more valid, all right? Then we have bullish. So we're uptrend. Bullish just means uptrend, and then bearish just means downtrend, okay? So with the bullish trend and uptrend, we are focusing on going long off demand. And demand and supply are zones that I'll be telling you guys about in this video a little bit later on right now. But that's basically, as a bullish and uptrend, you want to get on the dip. Buy at the dip. So you want to go long. So it's an uptrend, you want to buy here so you can go long. And bearish trend, you want to go short off supply. So you want to short. You want to trade because you're predicting the market to go down. So then you go here, it dips down, it makes a lower high. You want to go short, so you would trade here so you could go down. That's basically how you play off trends, and you're gonna want to play off trends most of the time, because as a beginner, I've been doing this for a long time. Most of the time, like literally 95% of the time I trade, I go with the trend. 5% of the time, sometimes I go against the trend, but that's because I've been doing it for so long. I understand how the market works. I understand the market condition, okay? And as a beginner, because when I first started, I'm telling you guys this from experience, go with the trend. It's just going to make you guys better as a trader, as a beginner. And then I'm not even going to show you how to go against the trend or what you need to know to identify as a solid confirmation that you can go against the trend. I'm not going to show you any of that because most of you guys are beginners, all right? We'll dive into that later on. But as a beginner, as a noob, you got to understand to go with the trend. It's always going to help you out, especially, you're trading real money. Why would you want to do something that's just stupid and, not correct? So just go with the trend and it'll make it easier for you guys, all right? But we want to find out how to identify trends and, long-term trends. That's the main key of first starting out to, charting. You want to identify trends. How to identify trends is very simple. You're just looking for higher highs and higher lows like this, and you identify the trend that you're in. I'll show you guys in the chart in a second here, but it should be very simple. This is probably one of the easiest things to do, but I'll show you guys in the chart how to do this, and you'll see how simple it actually is. But now we're moving on to what's important as well. All right, in trading, you got to understand trading is an auction. So just like real estate, just like selling cars, just like any type of auction that you have a buyer and a seller. Someone's buying because someone's selling. That's it, right? Then you also have dumb versus smart. So what I mean by that is first we'll say the price moves based on supply and demand and volume, okay? There's always going to be supply, there's always going to be demand for that, and there's always going to be volume, whether, low volume or high volume. But when I mean dumb versus smart, I mean that we have the retail traders, which is 3%. We are the retail traders, all right? We're the retail traders. And then we have the 97%, the big guys, the big fish, which are the hedge funds, institutions, banks, all of that. They are the ones that actually move the market. All those big moves you see are based on them, okay? So that's what I mean by dumb versus smart. We're considered the dumb, they're considered the smart, right? Because we're so small, we don't move the market. Our job is just catch it's not even to catch a small piece, it's to catch their waves, all right? We just want to ride along their waves that they make without even them knowing that we're there. That's basically what trading, if you're a retail trader, is. Just riding the wave that these hedge funds create, all right? That's it. I kind of like that saying, actually. I'm gonna make that into a saying. Riding the wave that these big guys create, all right? And without letting them know you're there. And then we have volume, all right? Volume, you either buy or sell. Obviously, in trading, there's buying or selling. And there's always a buyer and a seller for each transaction, as you should know. But how do we know who's in control? We look for aggressive and passive participants. You want to see how many buyers there are or how many sellers are by looking at volume, all right? And we can look at volume and just overall volume, but we can also look at it with volume with either buyers and sellers. We want to know who's in control, so we can see volume kind of like this, and we can understand who is more in control, and that will give you a better indication of where price should go to, all right? Then we got smart money concept. So smart money concept, that is the concept that I use with supply and demand and liquidity, which we'll get into in just a second here. This is the concept that I use to actually have an understanding of how the market works. Because like I said in this slide right here, we are the retail traders. We're 3%. That's very low. 97% are these billionaires, institutions, hedge funds. They're the ones moving the market. So smart money concept helps us understand that in a simple way, all right? We don't move the market, the big players do. But for the market to move, it must always seek liquidity first. And these liquidity levels, all right, we'll get into that in just a second here. But the market will leave clues of historical big transactions through these supply and demand zones right here, all right? These are big transactions, big volume plays, and this is kind of a historic, that's what it's called, a historic big transaction that you can understand where price is most likely to make big moves, okay? So big moves can't happen without liquidity being presented first. And this is how we identify our opportunities to get into the trade. But what is liquidity, right? To understand liquidity, in trading, there's many formal definitions for liquidity, but in trading, as a trader, you don't need to know those formal definitions. What you need to know is in trading, liquidity kind of acts like a magnet, okay? So when I say magnet, price tends to go to that level, that price level of liquidity, so that large investors, like hedge funds, like those billionaires who have a lot of money, their orders can get filled, all right? So that is what liquidity means, all right? So price tends to head to those levels and have a reaction, okay? A big reaction off those levels. So this is why we mostly like trading, retail traders, smart retail traders, because we are basically dumb. We're already dumb. We can't be any more dumb. So we have to have some sort of slight advantage, and that is by knowing how liquidity works. A lot of traders, they don't use this. They use all these random ass indicators that don't work, like MACD, RSI. Those people that try to sell you that, they don't understand anything about trading, all right? They just think they can use this indicator and it'll help them make a trade. Most of the time, it won't work. And at the end of the day, liquidity is probably the best form of actually finding opportunities to get into trading, okay? But yeah, like I said, man, we're retail traders. We're the few. We're the many of the few, and we're considered dumb in this trading world. And so we need to find our advantage here, and this is our advantage, all right? Smart money concept helps us understand that we aren't important in this, so we have to understand how to seek advantageous opportunities while trading, and liquidity is that. So how to find liquidity is you can look at session highs and lows. You can look at these session highs and lows to find where all this price kind of is gathered toward this price level, and you can find that by understanding that if you find these liquidity sessions, mostly through session highs and lows, where session opens, where the high is at that session or the low is at that session, you can find where a lot of buy and sell orders, all of these orders are filled at this little area, and you understand that price is going to make a big reaction. And if you have a good setup with a good strategy, you could potentially make a substantial amount of money, as well as lose money. But with following risk management, that's another part of it. You won't lose as much as you might make. Okay, but with higher liquidity, I like to say higher liquidity equals higher probability that something will happen. That's what I mean. Higher liquidity, higher probability that something will happen. Okay, higher probability that a big movement might occur. So that means a higher probability of you becoming profitable in that trade, you making money in that trade, which is why you should only go into trades that have high probability of a movement to occur. Whether it goes your way or not, those are the trades you want to go into, okay? You don't want to go in a trade where stuff is just consolidating in small price ranges, because that won't give you anything. That won't give you any upside. That won't give you, any benefit in getting to those trades, all right? But before we go into any more, like I said in the previous video, you already understand in the previous video what bid versus ask means, but might as well let me do it again here. And bid versus ask is the price at which you can buy an asset from the market maker, and the bid price is the price at which you can sell an asset to the market maker, all right? And we have the bid versus ask spread is just a subtraction between those two. But like we went on this option chain here, as I showed you here in the previous video, in the first part of the course, the only thing that we care about spreads, mostly through options, because future spreads aren't as bad, but option spreads, we want tight spreads. We want spreads close to each other in range, all right? So ask and bid, we want a close spread, like these. These are very close spreads. They're like 1 cent difference. That's what we want. We don't want like dollar differences, because that's such a wide spread that you will, like I said in the previous video, even if the play goes your way, I want to make this like clear to you. Don't choose whack-ass spreads. Don't choose these random-ass stocks, because they usually are the ones that have these whack-ass spreads. Because if you do choose those stocks, you'll end up with these spreads. And even if the play goes your way, you probably won't end up making any money, all right? You might even lose money. So that's all where the spreads means. That's what you have to understand when it comes to spreads, how to choose the right spreads. Just go for tight spreads, okay? Now, I love this quote here. Great traders don't predict the market, they adapt to it. And at the end of the day, as a trader, you have to understand that you don't see the future, all right? You don't have a crystal ball. You don't know what's going to happen. You don't know, but you can adapt to the market condition. You can adapt to it and understand what's happening right now. I can foresee the movement that it's going to make by adapting to the market condition at the end of the day. I'm not looking at the future. I'm just understanding how the market's going. And with experience, I can understand what it might do. So I adapt to the situation at hand, and I just use my strategy and my risk management, and it'll all be good. All right. I hope that made sense to you. So we're not really trying to see the future. We're not trying to predict the future. We don't know what's going to happen. But as like I said, trading is a game of probability. It might happen, it might not. Use proper risk management with a good successful strategy that has a good win rate, good win percentage. you're golden, all right? Because even if it doesn't hit, your win rate, your strategy has a certain win rate, let's say is like 70% or more, and you use proper risk management, you will become profitable if you stick to all of that, okay? So that's what you got to understand, all right? But practice, all right? Just practice. All you got to do is practice. You can't get good at anything if you don't practice, all right? I've been doing this for years, and every day I still practice. Every day I still learn stuff, okay? So practice learning the market condition. How's the economy at? What situation are we at in politics or any policies going on, for the economy? Look at the stocks. How are they doing? Look at companies. How are they doing? Identify the market condition and understand what's happening now. So if it happens again, you'll understand what the market could do. You understand the gist of the market and how it works. Because most of the days, the more you can have any strategy, you can have proper risk management, but truly the best knowledge you can have is by just experiencing how the market moves through all of these conditions, all these situations that's happening around the world. That's the best way you can gain the knowledge to understand how the market works. Okay, and then two, practice. Learning the long-term trend. Most of you probably think it's very simple, and it is. It really is. But like the more you practice identifying these trends, because you're not going to trade real money right now. You're a beginner, right? So you might as well do something and just practice these long-term trends to start. This is like the beginner basic things of what you should be doing first, all right? So just look at the market condition, practice long-term trends, figuring out if it's going on an uptrend in the long term, figuring out if it's on consolidating at the moment or if it's a downtrend, so you can find your best entries to get into plays and get into trades. So you can find out if you should go long, short, or you can go both, okay? Just do that. And then also for the last one, identify levels of liquidity. So that's probably the hardest one out of those three, obviously, but just learn how to identify these areas of liquidity by looking at session highs, session lows, identifying supply and demand zones by that, and you'll get better. I'll show you guys how to do this in two stocks, SPY and QQQ. Show you how to identify these. Very simple. You'll understand how to do it just by looking at me doing it, all right? But just keep on doing it, and then you'll get to a point where you can do this easily in seconds. It won't even affect you. You won't even spend time trying to, it won't even take more than a minute trying to find these zones and these session highs and session lows, okay? But supply and demand, as I showed you in that previous picture, this is what supply and demand is. Areas of high volume, high activity going around in these zones where price is likely to make a movement, okay? Because price can make a movement anywhere, right? But you want to make sure that where price makes movement and you're in the trade is at a good indication where price is more likely to make a movement, right? Price can make a movement here. Price can make a movement anywhere. But you're not going to get in this trade. Even if it does make a movement, who cares? It's not a good indication that price should make a movement like these areas are, okay? These zones, okay? This is where liquidity tends to sleep into most of the time, all right? Not all the time in supply and demand zones liquidity is, but most of the time, some of the times its liquidity rests around these areas, okay? But how to draw supply and demand, all right? So let's go into Thinkorswim here, okay? I'm in my Thinkorswim, and let me remove the EMA line here. You won't really need to understand what this means. This is an exponential moving average. This, as a beginner, is pretty good. I even use this sometimes too, but this helps you understand the trend of the market. It really does. This helps you get a gauge of how the market's trending up towards too. But even in my eyes, let's go to identifying trends first, right? I mean, you can clearly understand what trend this is in, right? This is an uptrend, creating higher highs, higher lows. This is an uptrend. And the EMA line, which you can find if you just go to studies, and then you just click on here and just search up moving average exponential. That's all you need to do. Then just click apply, and it'll come here. And this is basically what that means, man. This is the EMA line. It's exponential moving average, and all that means is it helps you understand how the trend of the market is looking at for that particular stock or SPY or QQQ. That's it. But I'm going to remove it for now just so it doesn't confuse your brain when I put these zones into place, okay? But remove study. Yes, I'll put that back in later. I might forget though. It doesn't matter. So let's go in here. So we're looking here. This is the 4-hour time frame. I always say when you're finding your zones, find it in the later time frames, 4-hour or more. Even if you day trade, it's always best to find these time frames because, like I said, you can go. Most times this will be the same areas. Sorry, some of the times. I think on this time this is the same areas because if you go on like 15 minutes, 5 minutes, 30 minutes, Some people do 30 minutes. I'm not gonna say it's wrong, but I think like 4 hours or longer is probably best. But sometimes these zones will be the same even if you go in the 5 minute, all right? Um, or the 30 minutes, sorry, the 30 minutes. Sometimes these zones will be the same, but just to give a clear indication of these historical price movements, where you're seeing the price actually go to, and it's looking like it's a good area where price is likely to make a big movement, you're gonna want to go in the larger time frames, okay? So as we can see here, how to identify these zones. Right now it's in here, right? Right now we're at a level where at the end of the day, I'm not really seeing anything great right now, okay? Right now we're at 532. I want to see it. Let's see here, right? I would say these are good levels, but it was breaking by these levels. As you can see, you would have plot levels here before this happened, this movement happened. Perfect, great. But it just dick straight through, like broke it. You're not going to plot levels here anymore, right? Because it just invalidated the zone, okay? So if you see a big ass dick candle like these break zones where you put in, it's invalidated, take it out. You might as well take it out. It might even go back here and do something with it, but just to make sure, it's always best to make sure, because in reality it shouldn't make any movement here for any setups to happen, but it might at the end of the day. It just might. The market does whatever it wants, but just for your best interest, just remove it. It's invalidated, okay? But we're looking at this right here, this zone, this level here. This was a session high that opened, and we can see it had very, very large volume here, with a very, very good price reaction, all right? This was a session high as well when the market opened, okay? So we can plot a zone here. We're going to plot a zone right at the top of this wick right here where the high was, right at the top. And then mostly it's okay. When I'm doing these zones, most of the times these zones will be the same as yours once you get into the groove of things. Most traders draw mostly the same zones, but it might be a little bit off to how you guys do it. It doesn't matter, right? It's okay. As long as you understand where you should draw the zones, what areas, because most traders will draw their zones here, right? They'll draw their zones in this area here, but it might be a little bit off. Some might go here, some might go here. So that's all I mean, right? It's fine. I'm going to go into the bottom of this tick right here for my zone, though, of this black one. And this is where I draw my zone. This is a supply zone, right? Supply is the top, demand is the bottom. So this is a supply zone right now, okay? And then I'm going to get into and draw the lows, all right? We see a lot of volume down here, which is good. I saw a lot of volume down here on the upside, and we're seeing big wicks. This was, I'm pretty sure, session open here. I saw a low here before session opened, and we're going to be drawing our demand zone right here. We can expect big movements to be made in this zone right here too, all right? And I'm going to put it at the bottom of this, right at the tippy top of this wick, right at the start of when it actually, goes into, colors, basically, right? So this is where my zones are. This is how I draw my zones, okay? And you guys should just keep practicing how to do these on like literally every stocks, every company, even if you don't trade like options. If you're in futures, go on ES. Even if you don't trade options, your futures, go on SPY, go on QQQ, which is the same thing as ES and NQ. Go on other companies like Meta, where you can put their ticker symbol right here. Go on other companies like Meta, all of that, Google, Tesla, and just try to find these supply and demand zones, these session high and session lows as well. But yeah, so I plotted these two zones now, and what I got to do is wait for them to come to these zones and for me to make a setup, which we'll be getting into in the video. And the setups, I do 3 setups most of the time when it comes to day trading, which give me a win percentage of 70% or more, which is very good. But yeah, once it comes to these zones, I will wait for a setup to occur. But yeah, let's go to QQQ and just show you guys how to do that one too, okay? So QQQ now, let me remove this. Now we're at QQQ and we're looking for zones to create here. So same thing right here. We see an area of very high volume and big wicks, understanding that price accumulated at this level and a big reaction was made, okay? A big reaction around this range was made. So you can understand that liquidity is involved around this area too, okay? I'm going to create the zone at the top of this wick to the bottom of this wick right here. This is where my zone is drawn for my supply zone. Right here, all right? Top of this wick to the bottom of this wick. Oops, I do this sometimes. And then, back here, we're going to look at another zone to draw here. As you can see here, where the session closes again, because QQQ and SPY are the same. They move in the same way, so basically the same kind of zones you're going to draw on both of them, which is very good. And if you just want to trade SPY and QQQ, go ahead, man. Most futures traders, they only trade like ES and Q, which is the same thing as SPY and QQQ. So go ahead, trade SPY and QQQ. I trade SPY and QQQ and blue chip stocks. When SPY and QQQ aren't doing what I want them to do, I go for the blue chip stocks. That's basically it, okay? But as you can see, I plotted my supply zone there. Put my demand zone right here, bottom of this wick, right before the color started going in, right here. This is my zone for the demand zone, okay? Same thing, and we're looking at session high and session lows. Where session opened here, we're looking around this area. Session closed, session opened here. We're looking around this area for high volume and just a big reaction being made at this level, okay? And then we'll wait for a setup to occur around these levels. And once it gets to these levels, I set alerts out most of the time as well. And once it gets to these levels, I wait for a setup to happen, which I'll show you my setups, and we'll get into the trade, okay? But yeah, this is how you identify, how you can draw supply and demand zones and all of that. This is how you can identify trends too. We're on an uptrend, creating higher highs, higher lows, just by simply looking at the EMA line that I showed you that I had, or you can even do a trend line here. Creating higher highs, we'll do it like right here. Higher highs and higher lows are bouncing off this trend line and going up, okay? That's basically how to do that, all right? Remove this. Fuck. I keep doing this sometimes. It pisses me off when I do this, and I do this a lot, man. You'll realize, you'll get used to this though. All right. Go back into the PowerPoint. Now these are the time frames like I showed you. There's 4 hour, 2 hour, 1 hour, 30 minutes, 15 minutes. Go when you're drawing your zones to the higher time frames, like 4 hour, 1 day. That's what I use, okay? And then when you're making a trade, unless unless obviously you're a swing trader, which if you're a swing trader, it doesn't just involve looking at charts. It also involves looking at companies too, because when you got to look at companies, you got to look at the economy's doing to get into swing trading, because that could all mess you up, because you're doing this for days, weeks, months. You're in a trade for that long. It could mess you up if you don't first go for that too. But when day trading, you're gonna want to go your 4 hour, 1 day time frames, plot your zones there, figure out your daily bias on those zones, on those large time frames, and then go down to like 15 minutes, 5 minutes to actually get into an entry, so you can get that perfect entry. That's why you go in the lower time frames, is so you can get a perfect entry, okay, when day trading. And most times you won't get a perfect entry even if you go in those time frames. But I always say, I never get an early entry. Never. It's always best to get a later entry than it is to get an earlier entry. You might not make that much money as you would if you got a perfect entry, but it's always best to at least be confirmed that the play is going your way, all right? So either getting a perfect entry or getting a little bit of later entry. But if it's too late, obviously don't get in the play. Don't. Understand. Don't get FOMO. Don't get the fear of missing out. Just leave it, man. You'll get another one, right? The time's not gonna end. You'll get another one, all right? This is the risk to reward. This is one of the most important parts of this whole course, okay? And what this basically means is you have a risk to reward because you have a win rate, a certain win rate of your strategy, all right? And you got to figure out what percentage your win rate is, okay? How good are you? What percentage are you at becoming profitable in single trades throughout a course of like 100 trades, okay? And a lot of people say, oh, I'm gonna do like 10, maybe do 20, something like that, and get your percentage. No. I beg you not do that so you can think that's gonna be your winning percentage. I beg you. The most important part is not your first trade, it's your next 100 trades, all right? That's what I like to say. 100 trades in, you'll figure out what your win percentage is. 100 trades. That's the limit, all right? Sorry. But get to the 100 trades, trading fake money obviously, and backtesting, all of that. Get to 100 trades, simulated trading. Figure out your win percentage. I know it's a lot. I know it's going to take time, but that's how it is. To take time. It takes time to become profitable, okay? But just use a simulated trading like you would do, real money, like you're putting real money into it. Do that with simulated trading. Do that with paper trading. See how good your win rate is. 100 trades. That's it sounds like a lot, but that's not. Okay, that's all it takes, really, man. And figure out what your win percentage is from that strategy and your risk management all together. And then look at this. Come back to this and look at this, okay? Take a picture here, screenshot this, because you're going to need this. This is important. Let's say you have a 20% win rate. Over 100 trades, you win 20% of it, okay? We're looking at risk to reward ratio. So if you risk one to make one, so if you're risking $10, let's say to make $10, that's a loss, all right? If you're risking $10 to make $20, that's still a loss. If you're risking $10 to make $30, still a loss. If you're risking with 20% win rate, $10 to make $40, you're at break even, all right? But if you're risking with 20%, you have to risk $10 to make $50 to actually be in profit, okay? And your strategy might be only 20%. My strategy isn't 20%. It's much higher than that. So I don't see you guys being anywhere here, but you might. That's why I put all this in there so you understand what win rate percentage you have. This is your risk to reward ratio that you should have to become profitable, okay? Now 30%, just a little bit less than 20% in terms of how much risk and how much your reward should be. So with the 1-to-1 ratio, risking 10 to make 10, still a loss. Risking 10 to make 20, still a loss. But risking 10 to make 30, that's profit. Risking 10 to make 40, that's profit. Risking 10 to make 50, that's still profit. So 30%, you got to go at least 1-to-3 ratio, 3-to-1 ratio, and above. And then 40%, if you're risking $10 to make $10, that's a loss. But $10 to make $20 and above, you're in profit. 40% win rate, okay? 50% win rate, you're at break even if you risk $10 to make 10. But anything above that, you're in profit, all right? And then 60% or above, which is perfect. That's a really good strategy. 60% above is a really good strategy when used with correct risk management, okay? That is, you're in profit even if you go from a 1-to-1 risk to reward ratio, okay? So you're risking $10 to make $10, you're still in profit. Above that as well if you have a 60% win rate. So this is very important. So like I said, take a picture, screenshot this, keep it in your folders, in your saved shit, all right? And just remember to come back to this once you figure out your win rate. And my win rate is above 60%. Most of them are 70%, and which is really good. And so I can use the 10-to-10 or 1-to-1 risk to reward ratio, all right? But you guys might not be able to. Even if you use my strategy, it's always different from, every trader is different, all right? Now, the setups, the good things, all right? You already know my concept. You already know that I use supply and demand. These are the setups of when it actually gets into these zones, all right? So when you get into these supply and demand zones, you need a setup involved, okay? So I have 3 setups that I use, and it'll show you exactly how I trade once price gets into these zones for a reaction, okay? Now the setups, zone bounce. So the zone bounce is the first one, okay? And most of these you're going to understand, zone bounce is very common sense. It's bouncing off a zone, but bouncing off a supply and demand zone. So as you see here, we have a supply and demand, a supply zone here. And the trade's been consolidating for a while, never really getting into this zone. I wait patiently for it to get back into the zone, and I get an alert, I see exactly what's happening with it. This is a bounce right here, okay? This is a bounce. And for a bounce, it's basically a reversal play. So we're going long, it bounces, I'm going in for a reversal play, okay? And this was a downtrend, by the way. And I took this play off Tesla, I believe it was. We're on a downtrend, and I took the play off short because I'm going with the trend. Again, always go with the trend if you're a beginner. 90% of the time, like I said, go with the trend. So we're on a downtrend, waiting for a reaction around the zone. A bounce happened. And How does bounce happen, Lucas? What does that mean? All right, I'm just looking at the chart and it says a bounce, not to get in. No, you got to understand how a bounce happens, okay? But this is a demand zone bounce. So we're on an uptrend and we go long off this bounce off demand. Like you just said here, this is just opposite direction, right? We're in a downtrend. I'm going to go short, so I'm waiting for a bounce here to go short. We're in an uptrend. I want to go long, so I'm waiting for a bounce on this demand zone to go long. But this is the zone bounce checklist, okay? So first has to be in a zone, in either in demand zone or supply zone, okay? That's the first thing. Is it? Great, perfect, it's there. Is volume dying off? So all that means is, look at the volume, all right? Is volume dying off? Is there big rejection candles, rejection wicks like this, indicating that, yes, price went there, but did it close there? No, it rejected it and it went down and created these kinds of candles, okay? This is good. This is volume dying off on the continuation, which means that there's not a lot of strong, valid confirmation that it's still going to continue. That's number 2. So we're in a zone already. Volume is dying off, and we're at the overall trend. Are we with the overall trend? Yes, this is in an uptrend. So yeah, we're at the overall trend. Guys, going along here. Are we in an overall trend? Yes, we're in an overall trend. This is in a short-term trend. A downtrend. So I'm going to go short here. So yeah, that's perfect. We got that. Is the candle close? So first, we wait. These candles is important. This is the bounce candle, I have to say. This is the candle that's giving me the bounce. I don't want to fuck with this candle that's giving me the bounce. I don't want to get into this play because I don't know if it's actually going to happen or not, all right? So I want to wait. Was the candle closed? Was it actually a rejection wick? Because even if the candle's not closing in a trade, it could always go back here and it's not a bounce anymore, okay? It could break into the zone. So wait for the candle to close. Did it close, and did it look like this? Did it look like a rejection candle? Rejection wicks. Yes. Now enter on next candle. So you found this, you understood this was good confirmation that it had a bounce. Get in on the next candle when you see upside for the reversal. As you can see here, we had a strong seller volume go in here, and that's what we got into play. Strong buyer volume looking here, nice green candle, and that's what we got into play. All right, and then my stop loss. I'm going to show you guys how to do a stop loss in a second, but just to show you guys where it'd be like above this level right here, which would be invalidated, above this level here, which should be invalidated as well, okay? But that is the bounce checklist for a zone bounce, all right? My win rate percentage on this one, 71%, I believe, which is pretty good, not bad at all. And yeah, so just make sure it's in a zone, a supply or demand zone. Make sure volume dies off. With overall trend, is it going in an uptrend? And are you going long off that? Is it going in a downtrend? Are you going short off that? Or is it consolidating? So you can go both levels too. Make sure the candle's closed. We don't want to get into this candle here that's creating the bounce. This is known as the bounce candle. Leave it alone. It's your friend, but don't touch it. You don't it's not giving you consent, all right? Don't touch this candle. Don't get into this candle. Get into the after one. Let it close. Is the candle closed? Yes. Did it look like these candles, like rejection candles? Yes. Enter on the next candle. That's it. All right, it's perfect. It's simple enough because that's what you need to do. You need to make it simple. If you're not making it simple, your brain's going to get confused and you're going to end up just losing a lot more trades than you should have, okay? So always make it simple. Trading should be simple, but these people make it look so complicated for you because they want to sell you something, but it's not that difficult. Make it simple and you will become profitable. That is what I preach. And then we have a zone break and retest, all right? Like I said, common sense, just like the zone bounce, it's bouncing off a zone. This is the break and retest. It's breaking off that zone, then retesting back up, and then going back on the continuation, okay? So what that means is, as we're looking here, we're looking at the breakout. This is the breakout happening. This is a supply zone. We're on an uptrend. It's breaking this zone, coming down, retesting, and at the end of the day, some of you guys might consider this a retest. I don't see any candle close in the zone, so this is not a retest, okay? I'll say you guys, on my checklist I'll show you of how to look for it, identify it. I'll show you guys exactly what I mean, but this isn't a retest. This is a retest, okay? So just wait for the retest patiently. Comes back down, doesn't break the zone, doesn't close out of the zone here, and then it goes back up, and then you wait for the candle to close for you to get into an entry. And then this is the downside. We're in a downward trend, obviously. Breaks, wait a little bit longer, obviously. This takes patience, but wait for the retest to come back up. Didn't get out of this zone here, didn't invalidate this zone, and then get into the next candle entry, which I'll show you guys the checklist. So zone break and retest checklist. So zone break with big momentum and volume. Did it have big candles that close above or below the zone depending on the trend? Yes, it broke with big momentum and big volume on an uptrend, all right? Big green candle here too. That's good. And then on this one, broke. Big break here with big volume, big candles. Great. Is there increasing volume on the break? Yes, there is increasing volume on the break, all right? Volume has increased during this break, which gives you a nice hint of continuation on the upside. But you don't want to get in that moment, because even if there is nice confirmation because there's increasing volume on the break, you want to wait. Wait. First, see is the overall trend. Yes, it's with the overall trend. This is going in an uptrend. We're going for longs. Perfect. This is a downtrend. We're going for shorts. Perfect. That's it, all right? And then you got the retest. Now, on the retest, the most important part is there dead volume on the retest. So once it's going into the retest, this isn't a retest. It could have been a retest, but it's not, so I waited again. This is the retest. Is there dead volume going on in this retest? Is the volume on the sell side very light, which is indicating that this isn't as valid. This isn't a strong sell-off. All right, it's very light, which is indicating to me that if it comes back in the zone, a retest is likely. Okay, so is there light volume going on the reverse side? Yes, perfect. Is the candle closed above or below? Oh, sorry, here. Is there light volume going on the upside? There was. All right, these are this one was a play I did get into. This one wasn't, but I do understand that this was. I saw the volume here when I took the screenshot. And it was light volume going in. But this was a play I got into, and this was light volume going on the upside, all right? So I wait patiently. This was very light volume going on the reversal side. So I waited for it to get back in this candle to actually confirm that it was a retest, okay? And would the candle close above or below the zone? Yes, closed above or below the zone. So this one closed above because we're going long. Closed above, great, nice retest. Close below, great, nice retest. Fuck. Close below, great, nice retest here, right? Then, again, enter on the next candle. Wait for this to break, close, great. I'm entering in this candle because this is a great confirmation for me for the break and retest. Close, great. I get in somewhere here, possibly here, you know. Some people might get in here, I might, but I'd probably, fend my fences a little bit and get into this candle here, all right, as soon as this candle opens. But yeah, enter on the next candle, and there you got it. This zone break and retest setup, win rate percentage is, I believe, 75 to 78 winner percentage, all right? Very good, very good. So that's all you got to know about zone break and retest, all right? So just wait for it to break with very big volume for continuation, like this on the upside and like this on the downside, and then wait for the confirmation. Even though there's great confirmation that's going on the upside, wait for the retest. Is the retest having very light volume? Not a lot of sell-off or not a lot of buying? Great. That's indicating that its reversal is very weak. So I want to wait for it to go back in the zone, and then I want to see, did it get into the zone, and is there no break or close break of the zone here? Great. That's even a better indication that it's very weak. The sell-off is very weak. And then did it close back up? Did it go back up and retest, back up and close out of the zone? Yes, perfect. I have great confirmation enough already to get into the play. And this thing, just the opposite. Did it go down? Did it break this demand zone with good confirmation? Yes, good volume, very big volume. Was a retest very weak in volume? Not the retest. Was the reversal very weak in volume? Yes, perfect. All right. So wait for the candle to close. Once it goes back and retest the zone, and it does not break above and close above the zone for invalidation, yes, perfect. And I wait for the candle to close here for me to get into, and it'd be very good confirmation that it's going to keep going on the downside, so I get into this candle right here, okay? The second candle after this candle closes, I get into this candle. That's it, and then you enter on the next candle. Perfect. Now, the final one, liquidity sweep, and I like these the most. This is my highest percentage win rate, 78 to 80% win rate. Perfect. Liquidity sweep, what it means, all right? So you're looking at the chart here, the setup, but I'll tell you guys what it means in terms of actually definitions, all right? So as you know, liquidity in trading means it's acting like price. It's acting like it's like a magnet, right? Where price goes to, because these large investors want the price to go to these levels, all right? And once it gets to these levels, sweeping liquidity just means that these investors, which this is a liquidity zone, these investors sweep this area right here. So all these orders that weren't filled get filled, and then reverse their side back up. And why does it reverse back up, right? Because these big investors, they want price to get to that level so they can fill all these orders, right? And when they do, there's no push. There's no more push, right? So they sweep liquidity here, but there's no more push on the continuation because they're out. They're out. So there's no more push here. So once they're out, price is not strong enough to go in continuation, so it's likely to reverse back on the reversal side, right? So here we swept. This was a liquidity zone, or in terms of zones, demand zone. It swept the liquidity of the zone with this candle right here, and once it's swept, that means all these orders got filled, right? Sorry. Damn. But all these orders got filled. And then what should happen next? Price should be continuing in continuation, right? But no, because in reality, all these orders got filled. The big investors, they're not there anymore. They're not there anymore to play the game. So it's not strong enough push for continuation anymore. So the likely thing that is to happen, like I said, is the reversal to go to reverse. So that is what liquidity sweep means, all right? We wait for it to sweep this zone of liquidity, and then we go into the reverse side play. So this is in an uptrend. So we wait for it to sweep a demand zone, liquidity, and then we go in upside trend. But if it's in a supply zone, we wait for it to, it's possibly, if it's a supply zone, it's on a downtrend. So we want to sweep the supply zone and then go down to a down, for shorts to go down. But this is on an uptrend, so you're going to go long on this, okay? But this is the checklist of liquidity sweep, okay? So it needs to be sharp movement into this key level, okay? So just like this candle, as you can see, there's very sharp movement going to this level, indicating a possible continuation, a strong continuation of it going on the upside. That's good. But I also understand that this could be this could either be a very good since this is going on an uptrend, this isn't gonna be a zone break and retest. This could either be a bounce or a liquidity sweep. Wasn't a bounce, so I was waiting for the liquidity sweep opportunity to present. So with the liquidity sweep opportunity to present, it had to be high volume going in into the key level, like I said, in this zone, indicating that a possible strong confirmation for continuation is there, which is good because I want to see that, because I want to know that these big investors are actually making making the price go there. That's a good thing, all right? So once you see sharp movement into key level, wait. And then you want to see a rejection wick like this. As you can see on the bounce section, kind of rejection looks like that, bouncing off the zones. It's kind of what I mean for the retest. For the liquidity sweep. Rejection look like this. Sweeping the liquidity, but rejecting it. So what that means is it closes above or below the zone. All right, it rejects this. Price went here, yes, like I said in the bounce, but it didn't get there. So that means it got weak. It got weak. It was very strong, but it got weak. It showed its true form. Okay. And after that, rejection wick, as you can see, the swept liquidity, but it got weak because it didn't close there. It closed above this zone. Liquidity sweep, like I said, closed above or below the zone. This candle, because we're going long, I want it to close above the zone. But if we were sweeping liquidity on the supply zone, I would want it to go, I would want it to close below the zone. So like I'm in a supply zone here. Let's say we sweep this liquidity here. I would want the next the candle for sweeping liquidity to close below here. But we're in long here, so I want it to close above, and it did close above. Great, good confirmation already for me. And then I enter on next candle, which is this candle right here, which is an imbalance, all right? So I enter in this candle for liquidity sweep, and then I take my profits, and then my stop loss would be just below here, because this is an invalidation level. Liquidity was swept, but if it goes past this, because they might try to fake us out, and get into here where most people put their stop loss. But if we put our stop loss here, most of the time, not all the time, but most of the time, 95% of the time, if it does go back here, it will be invalidated, all right? But yeah, that's basically how you identify liquidity sweep too. Liquidity sweep, like I said, is my most prominent, is my most profitable setup for my strategy. I don't see it as often as I do break and retests and bounces because it's so profitable. So I don't see it as often, but when I do see it, it does me well. It does me good, okay? So this is the 3 setups that I have in place. And now we're looking at stop loss, all right? So looking at stop loss, like I showed you in the stop loss for the liquidity sweep, I'm going to be telling you where you should make your stop losses, okay? So a first stop loss, which is what I usually do, is a break of key level. So either a supply and demand, an EMA, a VWAP, a VPOC, etc. All right. So usually I do supply and demand. I encourage you guys to mostly, as you're starting, mostly work on just supply and demand stop losses, and then get to the points where you put EMA stop loss, support and resistance stop loss, stuff like that. All right. But at the end of the day, I use supply and demand most of the time. So like I said here, you're looking at stop loss as on key levels. Look at this liquidity sweep. I got into my play here, right? I wanted it to be invalid, all right? So I could have put mine just above here, but this was liquidity, swap liquidity. This is an important level here, all right? Because if it comes back to this level, it could or could not be an invalidation. So that's why I put it a little bit above this level right here. This is where I put it, because if it goes past this and breaks this and it hits my stop loss here, a little bit below this little wick, then it's an invalidation for me, okay? That's a good stop loss to get into when you're doing liquidity sweep. You're doing break and retest. I put it here, right? I got into this candle and this entry here. Somewhere around here. So I want to put my stop loss for break and retest just above here too, all right? Just above this zone. Because then if it breaks this zone back up, that's an invalidation on my break and retest, all right? So just above. Don't put it here because it might go here. Put it just above it. Because if it breaks here, it's invalidation for me, okay? Bounces. I got into this play here. I'm bouncing because usually when I get in bounces, it has these kind of rejection wicks. So if it comes back up, I go in here just like a liquidity sweep kind of, but it's in the zone, yes. But just past this is a good bounce. If it goes below this, breaks past this wick, it's an invalidation for me on the bounces. Breaks past this wick, it's an invalidation for me on the bounces. Okay, so this is a good stop loss to put into when you're getting into these kinds of setups. And then you got break of trend. If it breaks a higher high or higher low, like I showed you what they mean, or a lower low or a lower high, that could also be a stop loss too. Or a percentage. If you're trading options, you can see percentage wise. Sometimes I do percentage as well. Usually my supply and demand levels where I stop loss, or my levels, like low of day, high of day, are my stop losses. They intertwine with my percentages as well. And I've been doing this for so many years because I know how that works. But just focus on, either doing supply and demand, EMA, or percentage level too. You could be like, okay, I'm going to trade. My stop loss is going to be a loss of my trade of 20%, 50%, 30%, 50%, what have you. And my take profit will be, depending on win rate percentage, obviously. It could be like 30%, 20%, 50%, 100% to take all profits, anything like that, okay? But just determine a stop loss. Determine what your stop loss should be. I encourage you to either be supply and demand or a certain level, a certain key level, a break of key level, not a certain level, a break of key level, all right? So like a break of supply and demand or a percentage, all right? But if you're trading futures, a supply and demand, EMA, all these levels are perfect for your stop loss. And then options, percentage is also perfect too, okay? Take profits. The take profit should be at the next coming supply or demand zone or support and resistance level. So I don't trade support and resistance level, but they're great for taking some profits. Let's say you want to trim some profits out, like take a little bit out and keep most of it. That's why you go support and resistance levels to take some out, or the next coming supply and demand zone to take most of your, or take all of your trade out too, right? So if we're going like zones here, I'm in this play. You can take some out here, you can take all your trade out here, this level too, okay? You get into this play, you got into here, I could trim some out maybe here, or I could take my profits out, not all the way down here, because I don't know if price is going to get to that level. Because this could just like it was here, is a little trend, a little uptrend that's happening right now. This happens a lot, okay? When you look at the charts, you can see this happens a lot. That's why I always want to take it a little bit. I want to take it before this break. So that's why I want to, if I take it before this break, like right here, I have a better understanding, better confirmation that's actually going to hit this line, unlike if I take it at the tippy top or the dip. all the way to the dip. So always take your profits a little bit before, okay? Like, it's crucial. Remember this. This is going to help you so much. Always take your profits a little bit before. So let's say we're going in this play, breaking retest, we got into this play here, right? Always take your profits like maybe around this level. You know, there's no zone here for me to get it, but take your profits maybe around this level. Let's say this was let's say a zone, maybe a zone was like right here, right? We had a supply zone here. Take it a little bit before, like right here, okay? It's just so you understand that, because you don't be greedy, all right? Don't be greedy. Just take it a little bit below it, or if you're going off a supply zone, you're going short, take it, or a supply zone going long, a little bit below it, always a little bit below it, okay? Take profits, don't be greedy. Green is green. Green is green. Money is money. Money in your bank account is money in your bank account, all right? But yeah, and it can also be at a certain level, percentage level that corresponds with your risk to reward. I trade options. I use levels. I use certain supply and demand zones, certain support resistance levels too, but that corresponds to my percentage levels too. So I get into a lot of contracts. I trim. I take some contracts out. So let's say it goes to like 20%. I like to play. I might take some profits out. And then it goes to like 30%. I might take some profits out because I get into a lot of contracts. As a beginner, you don't. So I wouldn't really consider being too greedy, but I also understand that you have to be with your risk to reward. So just make sure, you know, if at a certain percentage level, I usually do 20% when I trim some contracts out first, then it goes up increasingly. So 30%, 40%, 50%, what have you. And then I take most of my contracts, leave just runner size, which is just a little bit of contracts. So what runner size means is, let's say I buy 50 contracts, right? I take most of my contracts out, like 45 or just 40, 10 contracts is runner size basically. All right. But yeah, just make sure you take profits as at a certain key level, just like your stop loss. So either stop loss be a supply and demand zone, EMA, or a certain percentage if you're trading options, like 20, 30%, 15%. Great. Determine it first. Then your take profit. Determine it. Is it going to be a supply or demand zone? Is it going to be at a certain price level? That's a key level. Is it going to be at a certain percentage level, like mine kind of is? You know, if it hits 20%, I'm taking some trims, taking some profits out, and then it goes 30%, 40%, just wait, all right? And then on my stop loss, as a stop loss, all right? But before you trade, first, I'm going to let you know about the runners. But let me tell you first, before you trade, let me tell you something. Determine your stop loss and determine your take profit. Never risk more than 1% or 2% of your total account. So if you have a $1,000 total account, don't put in like $500, all right? In one day trade, never risk more than 1 or 2%, all right? So don't put $100, don't put $50, put $10, $20, maybe even less than that, all right? And I know it sucks, but at the end of the day, you don't have enough money, you know, to be able to make all the, you know, put all this money in, like $100, $200, $500, $1,000. You don't have that money now. That's just gambling, all right? This is proper risk management. Proper risk management is never risking more than 1% or 2%, 1% to 2% in a day trade of your total account in day trades. Okay, so if you have $1,000 account and you're day trading, don't put in that much money. Only put 1% or 2% in, or maybe even less. Right? Crucial, most important. Risk management is the most important thing of all, because if you don't have risk management, trading turns to gambling. All right, they're very similar, but risk management is crucial in trading. And if you take that away, you're just gambling. All right, you're just gambling your money away. So understand, however much money you have, you know, make sure you never risk more than 2% of it, okay, in a day trade. And only trade based on risk. Like I said, risk management is crucial. If you see a setup and it does not collide with your risk to reward ratio, like you're risking too much to make too little in a trade, do not take it. Be patient. Again, you're not going anywhere, man. Just chill out. Wait for your next opportunity to come that aligns with your risk to reward ratio. All right? Just chill out, be patient, and it'll come. And everything I'm saying, it's from experience, all right? I wasn't taught most of these things that I'm teaching you right now. Like this. I was not taught this. I went through this with experience. I failed a lot. And now I'm telling you guys this so that you guys won't fail, all right? And leaving runners, which we're going to say. So when leaving runners, only leave runners if you have 5 contracts or more. So more than 5 contracts or 5 contracts, all right? This is where you can only leave runners. If you have less, just take your whole contract out at a certain level, right? But if you have more than 5 contracts, great. Leave some runners if you're good with it, all right? I get into a lot of contracts and options, so I leave So I trim some out until I get to a runner size point, or I take my whole position out depending on how I think the market's looking. All right. But if you have more than 5 contracts, you can find by means leave runners, but I wouldn't recommend it unless it's a really good setup. But yeah, your first TP though has to be a significant profit percentage or a significant level, right? So 20% for me most of the time, unless I see a very big invalidation or I'm not liking how it's looking, which is very rare. I'll take it at like 15 or something like that, right? But most of the time, it's like 20%. I'm taking some trims, very light, but taking some trims, and then it keeps going up percentage-wise, increasing my trims to a point where I just leave runner size or I take my whole trade out. All right. But yeah, first DP has to be a significant level, okay, or significant profit level. And then watch volume as an indication to get out of runners, all right? So that's what I mean by I might take my whole profit out or I might leave runners. Or if I'm in runners, I have to literally be in that play and check just to see if nothing bad is going to happen with those runners, to see how the market's looking, if it's still going to continue to my benefit on my side. So if volume is good, you can still with the runners, but if volume is not, get out. Never let runners go red. If I'm in runner size, I go break even on these runners. So I'm not losing money on these runners, all right? So I made money. Let's say I trim most of my position on options at like 50%, right? I'm in runners. If my runners go and break even, I'm not letting that trade go red. I'm going and break even or a little bit in profit. So never let your runners go red if you can get in runners, okay? It's crucial that you never do that. It'll show you a bad way of trading, okay? So just make sure that if you do leave runners, watch closely, because if it's going close to break even, just get out. Pre-market plan. So with the pre-market plan it's a good form of just understanding that, getting first accustomed to what you're going to do, looking at the charts before you're actually going to make a trade will help you so much, all right? Always have a plan. A plan is great to have in any way. Like, look at Batman, all right? Yeah, he's a cartoon. He's an animated character. He's in a comic book. He's not real, yes. But at the end of the day, he's scripted like a perfect human being. That's what he's scripted like, right? Batman is the perfect embodiment of a human. He basically is a superhuman, okay? But he's just human. He has no powers, but he has a plan. He always has a plan. He can defeat everyone through like that's stronger than him. He can defeat Superman. He can defeat people that are just like 100 times stronger than them because he always has a plan. A plan will get you far, my friend, all right? So always has a plan. So this is the pre-market plan that I have. Identify key levels of the index or derivative you're looking at. So what that means is identify the key levels of whatever stock or whatever ticker index you're looking at, like ES if you trade futures, or NQ if you trade futures, or SPY and QQQ if you trade options, or these blue chip stocks like Tesla, Google, Apple, all of that. Find the key levels, find their liquidity, find their supply and demand zones, which I showed you how to do. And then check news, number 2. Look at FOMC, look at CPI, look at Powell, look at the unemployment rates, look at PPI. All these are important because when you check news, you can see, what they're doing to the charts. Look at the charts when you check news. When Powell speaks, most of the time, I wouldn't trade when Powell speaks because his words can just make the market go in ways that I never knew could go, all right? So just don't go into trades when news like this is happening, all right? Because you're new. Sometimes I do because I'm very confident in my setup and maybe I'm in a trade before and I have to go through the storm. Yeah, but 99.9% of the time, I'm not trading when they speak, okay? Or when news is coming out like this, like FOMC, CPI, Powell, PPI, and employment rates. I'm not speaking, okay? I'm not trading, sorry. But yeah, check news, see what's happening first. Identify the overall trend, when you're doing the key levels, identify the overall trend. Is it going in an uptrend? Are we good on an uptrend? Are we in a downtrend now? Where am I going? Shorts, longs? Are we sideways so I can go anywhere? Cool. All right, identify the trend. Then define your plan. All right, make it define. If X happens, I will do Y. If B happens, I will do C. So if SPY pushes up into 500 in supply and sweeps liquidity at 501, and I see a large sell-off appear, I will enter shorts with a stop right above 502, right above that liquidity sweep wick, and take a first profit at EMA line or support resistance line or a certain percentage level, whatever you have. That's basically what I mean by define your plan. Imagine in your head by looking at the charts, and then it'll happen. And once if it does get to that point where it does happen, you already know what to do. Okay. Do not stray from your plan. Very crucially, again, very very important. Do not stray from your plan. All right. As you get more experience, you will be like you'll be able to, stray and get away from your plans. But try to avoid this because, you really want to get consistent with looking and following your own plan, following your own setups, where you're looking at. I put my signals out, and I say I'm looking at, like, let's say I'm looking at SPY, or QQQ, right? And that's my plan, that's my setup out. But I've been doing this for so long. Something in my plan that I'm looking at somewhere else. Let's say I find out, Amazon has a really good setup. I might go in there. Not all the time, not most of the time, never. But I might, because I'm able to stray from my plan because I've been doing this for so long. I have experience in the market. I know how it works. But as a beginner, again, because I wasn't taught this, as a beginner, just stick with your plan. It'll make you get more consistent and more comfortable with your strategy and more confident, all right? So do not stray from your plan when you're beginning, all right? Entry keys. So, like I said, find out the right time for entries. Key levels, pre-market plan. So is it at a key level? Is your pre-market plan aligned with your entry? Great. See, are you not straying from your plan? Good. Do you have stop loss and TP, take profit figured out? Perfect. Is the entry trigger identified? Is the candle closed? Good setup. Entry trigger identified in the play? Perfect. All these 4 keys are good for you, then you're good to end the trade, and you shouldn't be worried, all right? If it goes in profit, good. You have your take profit set up. If it goes to your stop loss, good too. You have your stop loss set up, man. Yeah, you don't know your win rate percentage yet because you're trading paper trading, but just make sure everything's aligned, and then you'll figure out your win rate percentage, all right? But journal your trades, bro. Like, say, okay, this trade I won, this trade I lost, this trade I won, this trade I lost, and then keep going until you find your win percentage rate. But still, do all this, man. Do all this until, even if you're not trading real money, until you find your win percentage out, still do all this, okay? Now, this is everything. This was a little bit longer, obviously, than the first video. My bad. But this is everything about my strategy and my setups, okay? And yeah, this wasn't like a complete beginner of trading, This was just me letting you guys know what I trade, my basics, and how to use my strategy, how to use my setups, all of that. And at the end of the day, I understand that some of you guys are very, very beginner. Don't even know what trading is, all right? Don't even know what candles is. This to you looks fucking retarded. And I get that, okay? I get that. When I first started trading, it looked weird to me too. I get it. So I will be doing a boot camp, so to say. And with this boot camp, I will be going literally from the basics of everything. Basics of what trading is, what the candles are, what candlesticks looks like opening and closing, how candlesticks look like it's how our green candles and what our red candles, everything like that, all the way from the basics to the more complex stuff like my strategy, and understanding, all of that too. I'll be doing that after my 3rd part of this Trading 101 course, which is going to be diving into market psychology. The most important part. I said a lot of things are important here. Yes, I did. All right, sue me. But psychology is the most important part because it's aligned well with risk management, which I said is one of the most important parts too. Psychology will let you know that you're at fault for your losses, all right? You have to understand that. It's in your mind. So as you can see, why psychology is so important is because you're the one that's clicking the button to get in the trade. So it's your fault if you lose, and it's your fault if you win. All right? So you're the one that's winning and you're the one that's losing, all right? No one else is doing it. There's no external factor except for yourself, okay? So market psychology will dive into why people are like this, why people, revenge trade, stuff like that, and just help you overcome that too. I'll be teaching you guys how to overcome this mental block that most people get, and because this mental block that people get when it comes to trading is what makes almost every trader that failed. That's the reason. All right, that's the reason that most people don't fail because of a strategy and things like that. Most people fail because they quit too early because they're mentally deprived. And I'll be teaching you guys exactly how to not do that. And I was this close when I first started out. Like I told you, I had no mentor. I was this close to getting out because I was mentally deprived. I didn't, all right? I didn't quit. I overcome it. And I'll teach you guys exactly how to overcome it as well, because you're going to get into those positions. All right, you're not unique, all right? We're all the same people, all right? You're going to get this position where your head's going to be fucked up, and I'll let you know exactly what you should do at that moment when it's like that. All right. But yeah, man, that's everything I have to show you for my strategy, for my setup. Next thing will be market psychology for the third part. Definitely watch that one too. It's gonna be a little bit quicker because it's not all this, everything, a strategy. I show you the market structure, the setup. It's not gonna be this long, but it is gonna be very important still. But I will see you for the third part of the course.